Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Let's get to the three things you need to know.
First up, U.S. stocks soaring today as investors cheer the trade deal between the U.S. and China. The U.S. will cut the tariff rate on Chinese goods to 30%, and China will cut U.S. tariffs to 10% for a 90-day period. The temporary truce sending stocks on a tear, with all Magnificent Seven members moving sharply higher. Across asset classes, the dollar is also moving to the upside. Meantime, treasuries and gold taking a bit of a tumble.
Plus, investors also awaiting the April inflation report, which will show the immediate impacts of the Liberation Day tariffs. CPI categories that are China import intensive, such as toys, shoes, and apparel, may see some modest inflation. But overall, the CPI report is expected to come in closer to the Federal Reserve's 2% target.
And pharmaceutical stocks taking a hit today as President Trump says he plans to order a cut in prescription drug costs that could go as high as 80%. A potential decrease in prescription drug prices could have a significant impact on the industry's profits, particularly for companies that depend heavily on U.S. sales and could face lawsuits and resistance from the industry and lawmakers. The president will sign the executive order this morning.
U.S. stocks surging this morning as the U.S. and China strike a deal and a trade truce here. So let's break down all of the names and asset classes getting a boost on the back of the big news and send it on over to Yahoo Finance's Jared Blickery for a look at what is moving. Hey, Jared.
Thank you, Brad. The market action is dramatic, so let's let the picture paint 1,000 words here. And first, we're going to start with the Dow Futures, which is actually the laggard of the major indices. It's up only 1,064 points. And if we take a look at the NASDAQ, that's one of the leaders here. That's up almost 4%. Let me just show you a quick chart here. This goes back to Sunday evening, and you can see we gapped up, but then the real action took place right around the time Asia was closing. Europe was just getting its footing for the day. We saw another gap up there, and now we are holding on to these gains up 4%. Go to the S&P 500 futures, a little bit less than that, but the market's playing out in a very risk-on fashion. And as I've been kind of highlighting here, the market was kind of stuck in a prior resistance area, and now it is punching above that. So I'm not saying the all clear is sounding just yet, but we are very close to that point. Now, let me show you some of the other market movements that I've been tracking here. Here is the VIX. Let me just put on the VIX since Sunday evening, and you can see we have now dropped back below 20. That was a sticking point. That's something that I've been harping on here. Very important that we get back into the teens there. That just signals that institutional risk aversion is a little bit less. There's not that need for hedging activity out 30 days and more. Here's the 10-year T-note yield. That is moving to the upside, up 8 basis points. So is the U.S. dollar, as you guys were just talking about. That's also moving up 1%. That's kind of a big move here. Some people might say, well, the dollar heading higher is a risk-off move. What's more important to me is that rates and the dollar are back going in the same direction. This is what was happening pre-tariffs, and we just got started kind of reestablishing that correlation late last week. This really cements it here. And we got to wait to the close here to see what the end of the day brings, but I do have elevated hopes at this point. Here's gold futures, gold taking it humble, down 3%, same with silver. But now let's get to some heat maps. And I think it's really instructive to see the sectors that are surging here. So let me just break this down. I have the pre-market quotes in the little rectangles in each of these boxes. Leading the way is XLY. That's up 5.39% in the pre-market. And then in the big box behind it, I have the totals since that low that we saw on April 8th. So XLY is up 14.8% since then, up an additional 5% this morning. Then we have tech, then we have energy, then we have industrials, then we have financials and materials. What is not working today? Healthcare, and that's on other news, but you'll also know notice that was also negative since that April 8th bottom. Also lagging is staples and utilities and real estate. So basically the sectors that are not doing well are those that are typically more defensive. And so that just speaks as to the bullishness of the moment here. I want to show you next the best and worst performers in the S&P 500 this morning. These are the top 20. And again, I have the background. That is what's happened since April 8th. And then in these little boxes, we have what's happening pre-market. So Amazon leading the way, up 8.73% among some of these mega caps. Tesla also up 8%. You might remember, these were two big stocks that did very well after the election, November of last year. If I sort by performance, we can see actually leading the way is SWK, that's Stanley Black & Decker, definitely not an AI name. Then we have GE Healthcare, then we have Best Buy. And so a lot of the retail names that had gotten battered down from the February highs, those are doing very well today. I want to leave us off on the NASDAQ 100, and we can just see everything's flying. Lots of green on the screen here. And if I take a look at the equal weight, we're going to see a lot of chip names at the top here, along with some of the mega caps. So very risk on for a number of sectors, just not some of those defensive ones. And again, very nice to see historical correlations kind of reasserting.
It certainly is, Jared. Thank you so much for that context. And for our audience, Yahoo Finance will continue to bring you full coverage on all of the market movers throughout your trading day, so keep it here for more. But let's get to the details of the U.S.-China trade truce. Treasury Secretary Scott Bessent and U.S. Trade Representative Jamieson Greer confirming this morning the U.S. and China will both pause reciprocal tariffs for 90 days. The U.S. will now tariff China at 30%, while China will tariff U.S. imports at 10%. Secretary Bessent saying negotiations will attempt to balance the trade deficit.
Neither side wants a decoupling. We do want trade. We want more balanced trade. And I think that both sides are committed to achieving that. We would like to see China open to more U.S. goods.
Joining us now with more on trade is Greg Valliere, AGF Investments Chief U.S. Policy Strategist. Greg, great to speak with you. We got a lot to get to in a short amount of time here. This 90-day pause, where are the tariff rates heading from here? Is the lower tariff rate we're talking about this morning, that 30% and 10%, a floor or ceiling?
It could go a little bit higher. We're in now, Madison, for another 90 days of this. A rumor every day, a leak every day. Fighting back and forth. I'm happy to see this agreement, and I'm happy to see the markets up, but I think we still have a long way to go before there's a deal.
Greg, they say the devil is in the details, and previously, as we think about what the phase one of 2019-2020 trade deal looked like, it was $200 billion over 2 years that was anticipated and targeting manufactured goods, agricultural products, energy products, services. How much do you think a deal that may come forward between the U.S. and China will look similar to that, or are some of the categories dramatically shifted in what needs to be addressed here?
Hard to say. I think it'll probably look a lot like the earlier deal. We're arguing over the numbers. As you say, the devil is in the details. So I do think that in the world of trade negotiations, 90 days is not a long period of time.
So with that in mind, will they come to a wide-ranging, perhaps, conclusion after those 90 days here? Or do you think there are going to be different phases of trying to get a deal done?
Probably phases. I mean, there's a lot that has been left unsaid. Maybe we'll hear more in the next 24 hours. But what does this mean for Canada? And what does this mean for Western Europe? I mean, there are still a lot of angles to this story that have not been played out. And we have another big crisis that's starting to loom, and that's the decreasing prospects for getting a tax bill.
Greg, that's exactly where I wanted to go with you, because we know that the tariffs are supposed to raise $600 billion in revenue to feed through to $600 billion in tax cuts. If we continue to get headlines of these tariff deals and negotiations, does that negate any chance of those tax cuts coming in? How are you thinking about that?
The prospects for a tax bill have dropped dramatically. I think that Republicans were astonished and angry over the weekend when Donald Trump leaked out that he wants a tax increase on the wealthy. That's not Republican ideology. And I think you've got that. You've got a lack of agreement on how much spending to cut, how much Medicaid spending to reduce. So the tax debate is going to gobble up an awful lot of time in these next 90 days.
Do you think, especially knowing how some of what Trump in the first quarter essentially of his Trump 2.0 administration, has really rattled some of the people who were closest to him as well along the way, whether they be CEOs that were really pushing for him, and because they could anticipate perhaps to a certain extent, or at least they believe so, what a Trump 2.0 would look like. And now the deck is kind of totally shifted here. So how does that change some of the calculus from the administration's relationship with corporate America and some of the largest executives that are trying to have the year of the president for their companies?
It's a good question. I do think, though, that there's a positive angle, and that is that the markets prevailed. Trump had to capitulate to the markets. He had to capitulate to big business. He had to capitulate to a lot of members of the House and Senate. The fact that they are now going to act as a moderating influence on Trump is not a bad story.
All right, Greg, thanks so much for taking the time here with us this morning. We appreciate it.
You bet.
Well, stocks on a tear this morning amid easing trade tensions, with the S&P 500 set to erase all of its post-Liberation Day losses, while investors may be optimistic today. How bullish is Wall Street, some of the big money going forward? Here to break it all down, we've got Yahoo Finance's Josh Schaefer. Josh, what have some of the reactions been from what you've gathered on the street thus far?
Yeah, Brad, I mean, still early, right? So we're still starting to get just a little bit of reaction. But I guess to cover really this morning's action and what you're seeing in futures right now is just speaking with Keith Werner. He's the co-CIO over at Truce. And what he was saying to me is just simply put, you're seeing a better than expected style reaction in the market, right? I don't think the market was priced for the US and China to actually go have this meeting this weekend and have real news come out of it. And we did have real news come out of it. So I think you're just seeing a clear reaction to that. Jared was pointing out earlier, looking at the market, looking at what's up. Well, it was a lot of the biggest things that were down, right, sort of before we had this bounce. I don't think there's a lot of shocking there. Now, someone like Keith, who has been a little bit more on the bear side recently, said he feels like he still needs to see a few more key things perhaps happen, right? What happens over the next 90 days? What do we actually leave this 90-day pause period with? Then also when you think about the data, how does the economic data that has been disrupted from these tariffs over the past month actually play out? Similar story on earnings. What's a company like Walmart say later this week, right? How are they handling the back and forth here? Yes, obviously a positive news for a company like that, positive news for a company like Amazon, but how do they actually put that then back into their models, and how does that make them feel? Sort of remains to be seen, but I think if you're thinking on a short-term basis, I'll cite another source here. We're looking at research coming out from Citi's Stuart Kaiser. He's more of a trader type, right? He said this is a game changer because they had not been positive on a short-term trading basis overall on a lot of more risky areas of the market. He said, well, this opens that up. I'm now a little bit more positive, and again, calling it a, quote, game changer.
Yeah, and to double click into that, Josh, it's interesting. Ben Emmons overnight with a note talking about how the leadership is potentially going to change as we come out of this, citing the move forward that we've seen in the Russell 2000 in particular this morning. But I know you've talked about how typically when you're in a bear market territory, the things that got you down there tend to be the things that lift you back up. What are you hearing about what the leadership coming out of this moment might look like?
I think people have expected that something like the Russell would probably lead on the way back up, at least on the start, right? That's sort of how this normally would work, right? A lot of the names that get crushed over the past month, over the past 2 months, I mean, if you look at a year-to-date of the Russell 2000 or even a 2-month of the Russell 2000, it was going down a lot, right? So then, of course, it makes sense for it to pop back up. What's interesting when we think about an index like that, yes, it is more high beta, it usually moves more than the market on a day-to-day basis, right? But it also is a small cap index.
Right.
Those are small cap companies. How are they going to be impacted by tariffs is very different than how a large cap company is going to be impacted by tariffs. And I think people have generally been a little bit more bearish on something like the small cap from the Russell 2000 from that perspective. So does this really shift that story that much? Again, I don't know, right? I think right now you're seeing a big one-day bounce, and then people want to hear more still, see more, and also, as your prior guest was just saying, the headlines aren't going to stop. We're going to do this for 90 more days now, and again, this is just one deal. I think people would like to see the U.S. also make tariff deals with other countries as well.
Just lastly, while we have you here, Josh, and I know you geek out about some of the weekly fact-check data as much as I do.
Sure,
I know you were
Brad.
in Nashville, Tennessee,
Of course.
not paying attention to it last week, but one of the things that they called out was for Q1 2025, 78% of S&P 500 companies reporting a positive EPS surprise, and then ultimately here, the guidance, which has really come into focus in the outlooks here, 41 of those companies issuing negative guidance, 34 of those companies issuing positive EPS guidance. So all of those things considered, how are companies best positioning themselves for a period where they don't know if there's going to be a deal that either affects them positively or negatively, and how much of that still will pass on to consumers, which we're going to hear from one of the biggest bellwethers of consumers, Walmart, as they report.
Yeah, I mean, I think broadly it seems like strategists have been saying that earnings season is coming in a little bit better than people had hoped, right? Obviously that's a typical theme, but I think even just generally speaking, the entire vibe and sentiment has been a little bit stronger than people hope. You have seen estimates coming down though for the next couple quarters, which of course is also always a trend. But I think what's going to be interesting now is if you shaved about 4% off Q2 or Q3 earnings over the past month, is that the trough, right? Are expectations now low enough again for earnings growth? Company or strategists broadly and analysts still expecting earnings growth for the S&P 500 for the rest of the year, but has that now come down enough that it can go back up? And so if you can start to get EPS revisions coming back up instead of just the continuous trend down, then perhaps that starts to bring a little bit more fuel to this market rally, and you can start talking about something like the S&P 500 getting back above 6,000, and you start talking about a little bit more of a rally, right? That's what people are arguing. Mike Wilson still has 6,500 for the end of the year, and he feels like EPS revisions might have hit a bottom. Well, if those come back up, that's your support to really see a real rally in this
and
market.
potentially even relief that it's not as bad as some of the companies.
It's all
were guiding to.
expectations at some point, Brett.
Yeah, and certainly a big U-turn on these tariff negotiations. Thank you, Josh. Appreciate it. Coming up on the morning brief, we're going to count you down to the opening bell on Wall Street. Plus, President Trump is expected to sign an executive order lowering drug prices this morning, putting pressure on pharma stocks. We're going to bring you coverage from the White House press conference at 9:30 Eastern. And we're breaking down what to expect from Walmart earnings with an analyst. We're going to discuss that and much more ahead on Morning Brief.
Now time for some of today's trending tickers. We're watching Magnificent Seven stocks, airlines, and pharmaceuticals. First up, let's talk about that Magnificent Seven rallying after the U.S. and China agreed to tariff reductions. The stocks are up nearly 20% from their April 8th low here. And there you're taking a look at NVIDIA, Apple, and Tesla on your screen. And then perhaps we can take a look at the rest of them as well here. Amazon, of course, was one that we did see ripping to the upside here pre-market. And here's kind of a piece of the negotiation and the deals that we are still waiting more details around and still will need to be negotiated out in full. But if you're looking back and trying to use the 2020 deal as a measuring post, there could potentially for these tech companies be major advances, at least in intellectual property protections here, which as you think about how many of them are trying to either make sure that their products continue to remain available in China or the Asia Pacific region more broadly, and what intellectual property protections they would like if they are putting products in that region, whether it be chips, whether it be smartphones, they all want to make sure that there's a crackdown on counterfeit goods, that there's improved protection for trade secrets, and then measurements against some of these forced technology transfers. And so if you were able to insulate that and offer them some of those protection, that could potentially be a boon on top of, Apple not having to, charge U.S. consumers as much because they would be hit with more tariffs to get their products from production in China into the U.S. and vice versa.
Yeah, it's interesting off the back of Apple this morning soaring not only because it's going up alongside the rest of the market, but also because of that announcement on potential increased prices. That is according to the Wall Street Journal this morning, citing sources that Apple could be lifting iPhone prices, not tying it to tariffs though, because they don't want to have that headline crossed that they're lifting prices because of tariff policy here. But interesting to see the entire basket moving up. NVIDIA in particular, interesting because we didn't get any headlines specific to export controls on chips specifically, but yet it's moving up alongside the broader basket. The Mag 7 currently on track to be in a bull market if it continues to move to the upside.
Only other thing I'll say here on the Mag 7, Amazon perhaps could have been one of the biggest WTF moments that happened for the White House to have to consider as part of the broader trade negotiations when it leaked out some action that eventually was refuted by Amazon in saying that, or there was a report that said that they were going to list what the increase in prices was due to tariffs. Right. And the White House got pissed off by that. And so that could have been one of the other major moments in this broader kind of timeline that we've continued to track here. And ultimately, interesting to see how Amazon, of course, a platform that really relies on some of those cheaper products being able to make their way into the e-commerce platform as well.
Absolutely. Well, next up, let's look at airlines. One of the biggest gainers this morning following the agreement between the U.S. and China to temporarily lower tariffs. Also coming after the U.S. government announced plans to spend tens of billions of dollars to upgrade the nation's air traffic control system. Looking at all of these stocks moving up across the board. The interesting thing, and Kevin Gordon from Charles Schwab pointed this out, he'll be on with us later, are services going to be an area where consumers still feel that they can spend going forward, even if you kind of try to put the toothpaste back in the tube when it comes to tariffs?
This one's difficult because you think about the summer travel season and how many consumers are still trying to figure out how much they have the propensity to spend versus recent years. We've come out of the years of the revenge travel, even the bleisure travel demand. And so now you're looking at a consumer that is being extremely discretionary about some of the travel and experience economy that they buy into, whether that be in parks and resorts. And of course, Disney, they were able to actually come out and signal a little bit more of a brighter light on that in terms of some of the investments that they're making going forward. But for all of the airlines, they have been up in the air about what the guidance in the near term, I'm sorry, I had to do it. They have been up in the air about exactly how they can communicate to the street where there's confidence in their guidance versus where they just need to level set and bring down expectations in order for them to beat on some of those lower bars as well.
Absolutely.
Finally here, let's talk a little pharma stocks falling as President Trump vows to cut drug prices by more than 50%. Trump says he will institute a policy known as most favored nation, where the U.S. government plans to pay prices for drugs that are tied to the prices paid by other countries. You're seeing shares of some of the largest healthcare stocks here moving to the downside actually right now. What this would essentially mean is that they're not going to be able to extract as much in some of those margins or charge higher prices that then buoy those margins as well.
Absolutely. And there's obviously criticism about the U.S. pharma companies being able to do a lot of the R&D that allows for some of that drug development to be a lift to these stocks. And in part, that's something the president will be addressing. He'll be speaking coming up here at 9:30 a.m. Eastern. We may have more headlines on those pharmaceutical stocks coming out of those remarks. You can scan the QR code coming up here below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, Tuesday morning, investors will get a fresh read on inflation with the April CPI print. It could be the first set of hard data to see a direct impact from the president's trade war. Currently, core CPI is forecast to rise 0.3% and that comes after rising 0.1% in March. Joining us now, Stephen Juneau, BofA Securities Senior U.S. Economist. Stephen, great to have you here this morning. Talk to me about this CPI print. It's coming at a very interesting time right after we get headlines of these trade negotiations. To what extent do you think that this week's CPI print is going to signal an inflationary backdrop before those deals were struck?
Yeah, well, thanks for having me on. So it's going to be interesting data for sure. I think it's probably the first month where we get a little bit of signs that we're seeing the impact of tariffs. And it's not going to be broad-based. I think it's probably more concentrated in autos. Remember, we had that front-loading demand where we saw new vehicle sales spike in March, really hold up very well in April. And we've seen prices from J.D. Power move up higher, used car prices move higher. So these things is where these items are where we think we're going to see really tariff effects. And of course, we had greater tariff revenue in April as well. So you could see broader signs in the core goods side. But overall, we're a little bit below consensus because we don't think this is the worst of it. We think future increases are likely to come, but this is all predicated on kind of assumptions prior to the news we got over this weekend, this morning, where we saw tariff rates really trimmed significantly against China. So that's going to limit upside risk as well to inflation in the near term, too. So there's still, it's a lot of moving parts right now, a lot to unpack, but it will be a very interesting data release tomorrow.
Stephen, perhaps you can help us make sense of something. When you have companies that are saying, and it's showing up in the data to a certain extent, how they're bringing in some of those imports ahead of time. We saw that within the GDP print, the first release of it for the first quarter. And now we're also thinking about, on the back end of this, the number of ships that just wouldn't dock, the vessels that were staying out of the port because they didn't want to incur the charges. And so how do you kind of read through those headlines and see where and assess where it trickles through to the real data that comes out?
No, it's what makes it challenging, right? We knew businesses responded to this with front loading. We know that inventory has been built up, so to speak, to kind of give you some runway to prevent kind of that immediate increase on tariffs. So I think that's where timing becomes difficult. So you probably have a little bit of leeway. You don't have to go one for one with when the tariffs kick in, I've got to raise prices. You have that inventory backdrop, so that gives you some time. And then with all this uncertainty out here with kind of tariff announcements changing by the day, tariff rates changing every hour, businesses are probably just trying to, muddle through this right now. So maybe you don't see those immediate increases. So I think that's where we've got to see it in the data. The Fed has to see it in the data. You heard from Powell last week that, there's a lot of uncertainty about how this evolves over the coming months. And they need to see that evolution. We as economists need to see some evidence of it, and we haven't seen it yet. So I think there's a lot of factors to unpack. And of course, obviously, the policy changes that we got recently is something that we have to figure out too.
Stephen, 30 seconds. Let's talk about the Fed there. What does the growth backdrop here change? How does that impact what the Fed will be able to do going forward?
Yeah, well, we were always in the camp that the Fed wasn't cutting this year. We thought that we would avoid a recession. We would see more of a stagflation outcome. So with inflation running away from the Fed, moving up towards a peak of 3.5%, growth at around 1%, that the Fed just wouldn't be able to cut this year. They wouldn't have a window of opportunity for that. I think that persists even in this revised scenario. There's less risk of recession, maybe less upside risk to inflation, but inflation still moves higher, and it was already running at 2.6% before this tariff shock.
All right, Stephen, got to leave it there. Thank you so much for joining us. Appreciate it.
Thanks.
We're going to have all your markets action ahead. Stick around. You're watching Morning Brief.
That's a live look at the opening bell in Midtown Manhattan at the NASDAQ. Powell ringing the opening bell. Yeah, go ahead, press that button. Get yourself some funfetti to start the week here. And you've also got Douglas Dynamics ringing the opening bell up on the podium at the New York Stock Exchange here. Let's begin this trading week here. Taking a look at the Dow Jones Industrial Average. We are up by 2.6, 2.7% here. This as the U.S. and China have agreed to a trade truce for right now, which lowers some of the interim tariff rates for both countries. Major move there. The market's responding in kind here as you're seeing the Dow rip to the upside by about 2.5%. The NASDAQ composite is up by more than 4% to start off today's trading session. And the S&P 500, that's up by about 2.9% right now. We're still awaiting some of the details around that, so we will see exactly where negotiations continue to play out from here, but no doubt positive reception, at least on the back of that weekend news. And taking a look at the sector action here out of the gate on the day. Yeah, I had to adjust my own vision here for a hot second here. Oh, come on, Staples. That's the only laggard right now. It's down by about 0.4%. However, you've got 10 out of 11 S&P 500 sectors in positive territory, led by, oh yeah, you guessed it, consumer discretionary and technology here. I'm going to get that chart to populate in a hot second, but some massive moves to the upside here. 5% for consumer discretionary, about 4% for technology, a little more than that. And taking a look, deeper dive into some of those technology names here. To begin the session, you've got Microsoft up 1.4%, Amazon, that is moving and grooving here. Boogie Wonderland for Amazon as it's moving higher by about 8.5%. And then additionally, Apple, Nvidia, Google, Meta, call them all higher here to start the day here. A few spots of red here peppered into the mix as we're taking a look at Netflix, bringing up the caboose actually. That is down by about 2.3%, but fret not. Let's just see if we could take a look at the year-to-date move that we've been tracking with Netflix as well here. It's up 24% year-to-date, while the rest of the market essentially has been trying to regain some of its losses over the course of that same scale here. And then just lastly here, before I toss it on over to Jared Blickery, taking a look at the 30 Dow components, the DJIA, as you would probably look it up on the Yahoo Finance platform. Taking a look at where we're seeing activity transpire out of the gate this morning. You still have some laggards. McDonald's, the golden arches, got a little bit of, oh yeah, that was populating. So let's see what's going on there. McDonald's, MCD, the golden arches, got a little bit of tarnish on them to start off today's trading session. It's down by about 2.2%. Verizon also down 2.3%. But same case here. Amazon, the leader. Nike, also higher by about 2.8%, likely due to alleviation, sigh of relief perhaps, for the swoosh around some of its own operations and potentially seeing it come into favor for its own manufacturing in the Asia-Pacific region coming off of the weekend's talks on trade. Let's get to Yahoo Finance's Jared Blickery for a look at what's moving a little deeper into today's tape here. Jared?
Thank you, Brad. Yes, a big sigh of relief and some enthusiasm in the markets. I want to show you a year-to-date. We have the major averages plus the Russell 2000, the small caps, all having their best day in a month. You'd have to go back to April 9th. Middle of the day, Wednesday, there was another trade détente announced by President Trump. That rocketed markets higher. I think the NASDAQ was up 10, 12% that day. Not as dramatic right now, but here's the S&P 500. Let me show you the 200-day moving average, because I've just been talking about this nonstop. Finally above it. Now we got to close above it, but the NASDAQ is in very similar territory there. We'll see if that populates, and if it doesn't cooperate, you'll just have to take my word for it. But I do want to get to the VIX just real quickly. I was showing that pre-market. It was under 20. There you go. It is down 20%. First time since looks like almost late March right there. So very much an improvement in sentiment there. Here's the 10-year T-note yield. As I was saying 30 minutes ago, very positive that it is moving in the same direction as a dollar. 10-year is up about 9 basis points, and the dollar is up over 1% today. And I'll show you the intraday chart there. And not cooperating, but we're going to move on to some heat maps. And I want to show you what's happening in sector action. Brad was absolutely right. Consumer discretionary taking the cake. Tech is number 2. Then you have energy and materials. So cyclicals leading, and then those defensive sectors like staples and utilities, those are lagging. You can throw real estate and healthcare in there as well. And if we take a look at the Mag 7, and I'll use the NASDAQ 100 to do that, we see Amazon and Tesla. They are both leading. Reminds me of the post-election in November, November 5th, 6th, 7th, and for about a month after that, we saw some huge movements in those two stocks. Tesla really had a nice run at the time. A lot to get to here, so I'm going to move over to my leaders, and it's interesting to track the thematic leaders today. We have retail. XRT just took the top spot, but then we have chips, then we have China, then we have aerospace and defense, and then we have disruption and regional banks. Really nice mix of broad sectors here, and we can just dig into some of those. Here's China. You can see Alibaba up 6%, Pinduoduo up 8%, and let's see if I can get retail in there. And if I can't, that's all right. We got a lot going on here. I'm going to move on to the futures market because not everything is going upside. We do have gold moving to the downside, and not really a surprise, more of a defensive trade right there. But gold is down, having its worst day in a couple weeks, and we can see that in this chart. It's down about 3%. This is the overnight action. I will show you the year-to-date, though. It's not like the bull market in gold is over. We just have the makings of a potential top here, and we'll see how this evolves in the coming days and weeks. Real quick, too, silver had kind of a comeback, and it's been interesting to track that. We saw that big drop overnight as equities were popping. Then we came back to the unchanged line, and we're just a little bit off right now. And I want to close the futures analysis with crude oil. WTI is up 3.72%. And let me just show you what it's done year to date here. Off of this bottom here, doesn't look like much, but that is up 14%. And that was that low there was a 4-year low. So that's pretty significant for crude oil. Just speaks as to the global demand picture. That was one of the markets that had me worried until basically this morning. So here's crypto. We're going to close out with the crypto trade, and Bitcoin just trading even, but it has done some heavy lifting work over the last few days. This is another year-to-date chart. Let me just show you the last 5 days because we had a surge starting late last week, and that kind of was a prelude to all this risk on action I think that we're seeing today. So Bitcoin was leading last week, and now it's just kind of consolidating some of those gains. And if I put the year-to-date back on, you can see it is now within about 3% of those record highs that we saw way back in January. On that note, I will send it back to you, Maddie.
All right, Jared, great breakdown as always. Thank you so much. It's time now for today's strategy session. The FOMO trade taking hold on Wall Street with investors piling into stocks to avoid missing the market rebound. So, should you chase the market rally? Joining us now on that, Brent Schutte, Northwestern Mutual Wealth Management Company's CIO. Brent, it's always great to speak with you. So, what are you telling clients today? Do they buy into the rally?
I hope they didn't sell into the falling of the market. And so to me, this is a lesson in why you shouldn't try to market time, especially when it's predicated on trade negotiations, which are fluid. This is why you pick a strategic asset allocation, working with an advisor. You stay true to that asset allocation, and you don't panic and sell when other people are selling. And therefore, you don't have to chase and buy on the upside. And so to me, if you are uncomfortable during the past 30 days with your allocation, you should revisit that right now and make sure that you're comfortable going forward, because I'm likely to believe there are going to be back and forth in the future and that we have not heard the end of the trade negotiations.
Brent, I'll take it one step further here. Do you buy just because the president says buy stocks?
No, you take a look at longer term fundamentals and you pay heed to those. And certainly there are opportunities, I think, in the market today. Small and mid cap stocks were not mentioned in your opening there. Those are trading to the upside today quite heavily because they are more economically sensitive and they are cheap. If you are longer term investors, you should focus on markets that are cheap. You should remain diversified. And to me, small and mid cap stocks right now are an area that investors have ignored because they have become fascinated with large cap US stocks only. This is where there are opportunities for people willing to think outside of that area and look 3 to 5 years out. And I think small and mid cap stocks are a perfect place for investors to make sure they are diversified and not just in the US S&P 500.
So do you like small and mid cap over tech at these levels?
We like small and mid cap stocks. They're our favorite asset classes moving forward. We also like international stocks. I think people got a lesson in international stocks not being dead. If you look at the international markets, they're actually up 12 to 15% this year, which is a surprise, I think, to many investors. And that is an area that I think it still has legs going forward because if nothing else, foreign economies have learned they need to stand on their own 2 feet. And they're going to be doing more domestic stimulus like in Europe to help their economies push along also.
How has this year kind of, I don't know, just shifted the entire mindset around what a defensive play for your portfolio is?
Well, I hope the entire year is bringing back diversification. To me, if you look at the last couple of years, we had an extremely concentrated market that has, unfortunately, I think, sucked investors in just to that narrow area. And at least in my history and my time of doing this over the past 30 years, diversification is the one thing that works. And so I would remain diversified, make sure that you own small and mid-cap stocks, make sure you own some international stocks because the future is still uncertain. And the way that you deal with uncertainty is not by being defensive, but by diversifying across different asset classes, because that is admitting that you don't know exactly what's going to happen, which certainly I think we've all seen happen over the past 30 to 60 days.
Yeah, how much volatility should traders be prepared for in the next 90 days amid this pause, and how should they potentially hedge against any of that volatility?
Yeah, I mean, I think you're likely to see, I think, a lot of questions answered in the next 30 to 60 days, especially on does the soft data leak into the hard data? And so you mentioned getting CPI tomorrow. We also get retail sales. I mean, there was an economy that was later in the cycle that we were coming into this. It got hit by tariffs. We'll see how much that actually impacts the hard data going forward, which is kind of going to drive trade, I think, in the next few days. And then the tariffs are going to be back and forth. I don't think this is the final resting spot for tariffs. We're likely to end up with overall effective tariff rates in the low teens, which is still higher than what you've seen in the past 80 to 90 years, which will likely have an impact on inflation and economic growth going forward, both probably in the opposite direction of what you'd like. And so therefore, I think there's going to be much more volatility over the coming months as we kind of sort through all the different issues that are still out there.
Brent, thanks so much for taking the time here with us this morning, just after the open. Appreciate it.
Thank you.
It's time now for our charts of the day. Let's send it on over to Catalyst co-host Madison Mills for a look at Tesla.
That's right, Brad. Taking a look at Tesla behind me over the past 5 days, you can see it's up over 12% with a huge pop coming into today off the back of that news of the 90-day pause on those triple-digit levies between the U.S. and China here. So for Tesla, it's not just about that 90-day pause and how that's lifting the entire stock market this morning, right? It's also about the fact that Tesla is exposed in China in particular, and that is in part why we are seeing Tesla's market cap here soaring towards that $1 trillion mark. Tesla, remember, having over 20% of its revenue coming from China in the year 2024. Remember that these tariffs, they don't only hurt U.S. consumers, they also hurt China consumers, right? And so if the Chinese consumer is struggling, they may not be able to buy as many Teslas. And in fact, we've actually seen a shift in consumption from Chinese consumers over to other brands, the likes of BYD, some of that homegrown purchasing taking hold and putting pressure on Tesla. So one of the key questions going forward, is that Chinese consumer rebound going to be good for a name like Tesla? And also more broadly, we've been talking a lot to our sources this morning about the fact that the leadership going into where the market stood on April 2nd will likely be the leadership that emerges as we do come out of that market lows. Tesla, of course, one of the biggest gainers prior to that so-called Liberation Day on April 2nd that sent stocks lower. So will we continue to see Tesla rebounding to the upside? Of course, that is a key question going forward, Brad.
Maddie, thanks so much. Coming up, Walmart's kicking off retail earnings this week. We're breaking down the biggest things that investors should be looking for. We've got your checklist next on Morning Brief.
Walmart set to report first quarter results on Thursday before the market opens. Analysts expecting strong results as consumers shop for value. Joining us now, Corey Tarlow, Jefferies Senior VP of Equity Research, who has a buy rating on Walmart and $120 price target. Corey, great to speak with you. What is the biggest thing you're watching out for in this print?
Good morning, and thank you for having me. So I don't think that this quarter is going to be great overall. But I do think that sales should be very strong, which is important because in an environment like this, when you have volatility, you have weather and fears around tariffs, there's a lot that can impact the way a consumer spends, the way a consumer thinks. And right now we're seeing a really significant shift into food away from general merchandise. So that should be very good for the nation's largest grocer. That being said, when you see that shift into food and away from general merchandise, it also comes at a margin headwind. And then the company also has a liability claims issue that it will be taking a little bit of a hit on in the first quarter, excuse me. And then they also want some flexibility due to tariffs to invest in price. And so you're likely to see still strong sales, but there's probably a wider range of potential outcomes for profit in the first quarter that I think we need to be cognizant of. And the next question becomes, well, what does the outlook look like? And there's a lot of uncertainty as it relates to that. Mm-hmm. But I was with Walmart management in Dallas about a month ago, and they reaffirmed the outlook for the full year. Now, this was about a week post April 2nd, mm-hmm. So still have a little bit of time to digest the news that we had seen. So I think this will be a really interesting quarter to get a sense for how Walmart thinks about the impact of tariffs on the full year outlook.
Yeah, with that in mind, Corey, and as you were mentioning some of the consumption mix shifts that we could see play out, not just in the results, but within the guidance as well, is Walmart the real recession indicator potentially?
Thanks, Brad. I think that what's very clear is that we are seeing higher income customers trade down into Walmart more. And 75% of Walmart's share gains are coming from higher income customers. These are people who earn $100,000 and above. And the other thing that was clear to me post my meeting with management was that Walmart is going to invest in price to drive market share gains. And so whatever comes of this economic outlook over the next 12 months, it's probably not going to look like what we saw a decade and a half ago in 2007, 2008. Might look nothing like it, but the reality is whatever consumer dynamics that we're likely to see with consumers becoming more stretched, prioritizing food, like I mentioned, we see Walmart emerging on top. And it's because of the value gaps that they're likely to have versus peers and do have even at present in some of the data that we monitor, which is really indicative of further market share gains. And it, just as an example, we're seeing traffic up low to mid single digits for a retailer that caters to 160 million people in the U.S. on a weekly basis.
Corey, just lastly, while we have you here, and knowing that you have a buy rating on Walmart as well as on Costco for the bulk buying category there, which Walmart also has Sam's Club, of course, so they both compete within that category here. Which is better positioned from an investor standpoint to weather any near-term, not just volatility, but also the consumer backdrop that we've been laying out?
Sure. Well, right now, as it stands today, Walmart's our top pick. It was our top pick as of last year. It's our top pick this year, too. And it's really because they're building a completely different P&L that no other retailer really has the ability and scale to do at the size that Walmart can. So that's building higher margin, recurring advertising revenue, recurring membership revenue with Walmart Plus and Sam's Club. These are the things that are likely going to unlock the ability for Walmart to invest in the business, to invest in lower prices, to invest in higher wages and still drive margins higher over the long term. There's not many other retailers that are going to be able to do that in this environment.
Corey, great to have you here just after the bell this morning, and appreciate you teeing up some of these retail results. We'll be watching this bellwether in Walmart. We know you will be too. Thanks.
Thanks.
Everyone, switching gears here, we've got some breaking news as we're monitoring comments in a press conference from the White House in the Oval Office from President Trump. Let's listen in.
If you don't stop it, we're not going to do any trade. People have never really used trade the way I used it. That I can tell you. And all of a sudden they said, I think we're going to stop. And they have. And they did it for a lot of reasons, but trade is a big one. We're going to do a lot of trade with Pakistan. We're going to do a lot of trade with India. We're negotiating with India right now. We're going to be soon negotiating with Pakistan. And we stopped the nuclear conflict. I think it could have been a bad nuclear war. Millions of people could have been killed, so I'm very proud of that. I also want to thank Vice President Vance and Secretary of State Rubio for their work and efforts. They worked very hard on that. We also, as you know, created a situation where the Houthis, for the first time ever, have ceased firing, and they've let it be known that they're not going to be firing at American ships anymore, not going to be firing at Americans anymore. This was a heavy barrage that lasted for approximately 50 days. And as you know, they've been in war essentially for forever. But over the last 10 years, they've been very difficult for other countries. Nobody was able to do what we did. But they stopped, and we take their word for it. Their surrogates and them directly said, we don't want to do this anymore. And so we were satisfied with that. In addition, yesterday we achieved a total reset with China after productive talks in Geneva. Both sides now agreed to reduce the tariffs imposed after April 2nd to 10% for 90 days as negotiators continue on the largest structural issues. And I want to tell you that a couple of things. First of all, that doesn't include the tariffs that are already on, that are our tariffs, and it doesn't include tariffs on cars, steel, aluminum, things such as that, or tariffs that may be imposed on pharmaceuticals, because we want to bring the pharmaceutical businesses back to the United States, and they're already starting to come back now based on tariffs. Because they don't want to pay 25, 50, or 100% tariffs, so they're moving them back to the United States. I spoke to Tim Cook this morning, and he's going to, I think, even up his numbers, $500 billion. He's going to be building a lot of plants in the United States for Apple, and we look forward to that. I really do look forward to that. But the talks in Geneva were very friendly. The relationship is very good. We're not looking to hurt China. China was being hurt very badly. They were closing up factories. They were having a lot of unrest. And they were very happy to be able to do something with us. And the relationship is very, very good. I'll speak to President Xi maybe at the end of the week. We have some other things we're doing. But one of the biggest things that we're doing, and I don't know if people realize this, but we made a great deal with China, great trade deal, but it was a much bigger deal originally, and then they canceled it right in the last day. Some of you faces I remember were there when that happened. I remember you. And we had a deal where they opened up their country to trade with the United States, and they took that away at the last moment, and then I canceled the whole thing, and then 6 months later we ended up doing a smaller deal, but it was a big deal. It was $50 billion worth of product that they were going to purchase from our farmers, et cetera. And we agreed to that. People thought it was 15 because they were doing 15. We made it 50 because I misunderstood the 15. I said, you got to get 50. Because when I asked, if you remember the story, when I asked, what are we doing with them? My Secretary of Agriculture at the time, Sonny Perdue, said, sir, it's about 15 billion and we're asking for 15. And I thought he said 50. So I said, so they came back with the deal at 15, and I said, no way, I want 50, because you said 50. They said, sir, we didn't say that. Anyway, bottom line, I said, go back and ask for 50, and they gave us 50. And they were honoring the deal, and we would call them up a lot for the corn and for the wheat and for everything. They were honoring the deal, and then when Biden got in, They no longer honored the deal. There was nobody to call. I would call on an average of once every 2 weeks to say, come on, you have to speed it up a little bit. And our farmers were doing great. I said to them, buy more land and bigger tractors, if you remember. That's what happened. But the deal was a very good deal. But the best part of the deal was that we opened up China. China agreed to open itself up to American business to go in. And it would have been a great thing, I think, for China. They would be able to see things that they haven't seen. They would be able to buy products that they had never been able to buy. Would have been great for American business. I think it would have brought unity between China, better unity between China and the United States. And the bottom line is that they canceled it the last day. We were all set to sign it, and then I went a little bit angry. I got a little angry. I said, they canceled the deal. The deal was done. It was all ready to be signed, and people went over. They came back to me, sir, they don't want to sign the opening up China. Well, the biggest thing that we're discussing is the opening up China, and they've agreed to do that. But it's going to take a while to paper it. You know, that's not the easiest thing to paper. But that's the single, I think, to me, some people would disagree. Some people would say we're getting a lot of money with tariffs or whatever. But, you know, especially when you add what we already have. Because remember, we're already getting the 50% on steel and different things. That's not included in these numbers. So you can add that. But the biggest thing to me is the opening up. It would be, I think it would be fantastic for our businesses if we could go in and compete with China. It would be a lot of jobs for China. It would be, I think, at a time when they can frankly use the jobs. And that's what we're talking about. So that's a very, very important element to add. So when Scott, I watched him speak the other day, and I think he didn't want to say it, but I said, it's okay to say it. Look, if we don't get it, we don't get it. But if we don't get it, it won't be a positive thing. But if we do get it, I think it's maybe the most important thing to happen. Because if you think about it, we opened up our country to China. They come, we don't, I mean, they have very few restrictions. And they didn't open their country to us. Never made sense to me. It's not fair. And they've agreed to open China, fully open China. And I think it's going to be fantastic for China. I think it's going to be fantastic for us. And I think it's going to be great for unification and peace. China will also suspend and remove all of its non-monetary barriers. They've agreed to do that. Well, they're very numerous. But again, to me, the biggest thing that came out of that meeting is they've agreed. Now we have to get it papered, but they've agreed to open up China. It's going to be great for everybody. And third, I'm very happy to announce that Idan Alexander, an American citizen who until recently most thought was no longer living, thought was dead, is going to be released in about 2 hours, actually. And he's going to be released before the eyes of Steve Witkoff, who has done a fantastic job. I know a lot of people that have a lot of talent. I know Steve, he had a lot of talent. But I know a lot of people with a lot of talent, but there's one that I thought had a special way about him, special personality, aside from being a good deal maker, had a special way about him, and it was Steve. Knew very little about the subject matter, who does, but he learned it in about 2 hours. And he's been fantastic, so I want to just thank Steve. But they're going to be releasing Idan in about 2 hours from now, or sometime today, let's say. And again, they thought he was dead just a short while ago. His parents are so happy. They're so happy. So it's, as you know, Idan's the only American citizen who's captured and held hostage by Hamas since October 7th, 2023. And he's coming home to his parents, which is really great news. I mean, to me, it's big news. They thought he was dead. So that's that. So we'll be heading there, and we'll be seeing 3 primary countries. You know all about that: Saudi Arabia, UAE, Qatar. On Thursday's meeting with Russia and Ukraine is very important. I was very insistent that that meeting take place. I think good things can come out of that meeting. Stop the bloodshed of the horrible, it's a bloodbath. But that 5,000 more, it's really much more, I'm trying to be conservative, more than 5,000 soldiers. Russian, they're not American soldiers, they're from Russia, they're from Ukraine, but they're people. They're human souls, and they're being killed at levels that we haven't seen since the Second World War. And it's every week. A lot of drone fighting. It's a whole new form of...
There you were listening to comments from President Trump regarding the most recent trade talks with China here. He did announce a few key things as part of his statement here, prepared comments as of right now, and we'll see if he gets to questions, and we'll monitor those comments for you as well. But it seems like the tariffs are still on for cars, steel, and aluminum. Those some of the categories what the president addressed going forward from here is where there still needs to be talks, and we're expecting more talks about trade prices as well for drugs. The president is also expected to sign a deal, an executive order on pricing shortly. We've got those details with Yahoo Finance senior reporter Anjali Khemlani here. Anjali, we're waiting for comments around what this drug pricing and the details around that would look like from the executive order. What is the best assessment that you're hearing across Wall Street right now?
Yeah, I would say that analysts are pretty wary about the implementation of this, and questions are still swirling about whether or not this is going to have the impact that the administration wants. We have had some insight into what is going to be in this executive order. White House officials did talk to reporters earlier today, and I have some of that for you. Take a look at what we've got. We know that last night President Trump did post on Truth Social about what is expected, lowering prices up to 80%. But what we do know is that this executive order is going to have sort of a multi-pronged approach. First of all, employing USTR and Commerce Department to take a look at what is happening overseas and ensure that the U.S. companies are being protected against what they called, quote unquote, discriminatory practices from countries that are negotiating those lower prices. Then they've also got the Department of Justice and FTC looking at anti-competitive practice, either here or abroad, looking at where they can look at M&A deals, scrutinize how these companies are doing business and whether they themselves are responsible for those high prices and what other levers here in the U.S. are doing that. Meanwhile, the FDA would be charged with expanding importation from abroad. We already know that that is in place for Canada. That is from Trump's last administration move. And he's looking at expanding that to other countries as well to gain access to those lower prices. In addition, the Health and Human Services Department would negotiate with the companies those lower market prices, matching the most favored nation. And if you recall, most favored nation being that one or those countries that have the lowest prices for any one drug. That does include GLP-1s. We know that's going to be part of the target. In addition, the question about whether or not this would then erase that pressure of pharma tariffs does not go away. It looks like the administration is still focused on that investigation into national security and whether or not essential medicines need to be onshored, and more focus needs to be put on the supply chain being onshored back here in the U.S. I did also ask about, what the thought process is here, and we heard from those officials saying that what they're looking at is, quote unquote, fixing the market and market forces. So that seems to be the main focus. They did talk a little bit about rulemaking, so that would include bringing in Congress. There does seem to be very little appetite on the Hill for anything to do with this, Republicans included. And the industry has been largely quiet till now, but they have been pushing back against this, and it looks like this could be sort of the next battle legally in courts and also policy-wise.
Anjali, thank you so much. Really appreciate you breaking that down for us. That's going to do it for the morning brief. You can join me in the next hour for more analysis on Catalyst. Stick around.